Ladies and gentlemen, good day and welcome to the FY23 earnings conference call of Page Industries Limited. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and 0 on your touchtone phone. Please note this conference is being recorded. And now, I'd like to hand the conference over to Mr. V.S. Ganesh, Managing Director of Page Industries Limited, for his opening remarks. Thank you, and over to you, sir.
Thank you, Vikram, and good evening, everyone. It's always a pleasure to talk to all of you, and thank you all for joining us on the call this evening. As you are aware, while we have reported a modest growth in revenue this quarter, we have continued our 9-month momentum. We typically have a long-term view of the growth scenario given the consumption, industry, and economic drivers. Therefore, focus remains on intensifying general trade distribution, modern trade expansion, including rapid expansion of exclusive brand outlets, growing our online business, improving our customers' experience, strengthen the product portfolio, and ensuring a robust supply chain. Let me take you through some quick highlights before CFO, Mr. Chandrasekhar, details the financial performance for the quarter and for the 9 months. Our Q3 revenue has grown by 3% year-on-year, but has shown a degrowth of -3% quarter-on-quarter, whereas volume has degrown 11% year-on-year and 7% quarter-on-quarter. Our margins have degrown this quarter mainly because of the higher material cost resulting from utilization of raw material which was purchased at a higher price in previous quarters. As you know, we built strategic stock during those disruptive months, and those stocks is what we were utilizing. There was also a lower absorption of labor and factory overheads. The lower than expected sales did not allow us to optimally utilize our production capacities. We also reinstated normal advertising spend as we are very confident about the long-term view of the growth, and therefore we are not holding back on that spend. A good share of that, however, was invested during Q3. As of December end, we are present in 118,838 MBOs, 1,228 EBOs, and 2,967 LFS. Our channel expansion continues to be in line with our plans. The market is not as buoyant as we expected, and this is mainly what has impacted the overall performance. Moreover, with our inventory getting back to normal and having a good healthy inventory, we actually have reintroduced and rolled out ARS process across all product verticals to optimize with inventory. While this is having a short-term impact on primary sales, we are confident that this will enable us to have a more robust and efficient distribution system over the long term. It is very important to note while primary sales declined in Q3, secondary sales volumes were not affected to the same extent. During the pandemic, due to volatility created by changes in product demand mix, and shortages in supply chain, we were compelled to pause the ARS, and distributors were free to order based on availability and based on their best judgment. This resulted in imbalance in channel partners' inventory. This quarter, we decided that it is better if we reinstate and implement ARS in full. This will help us to correct these imbalances as explained earlier. This not only streamlines supply chain, but it will also help in improving the ROI of the channel partners while improving order fulfillment to retailers. We look forward to your question after our CFO gives you further insights on our Q2 financial performance. I would also like to inform you that today we have Mr. Gagan Sehgal, our COO, and Mr. Rahul Shukla, President and Chief Retail Officer, who has joined us in this call and who will be more than happy to answer any questions that you may have in their domain. Let me thank you once again for joining into the call today, and I would like to pass on to Mr. Chandrasekhar, our CFO, to give you further highlights.
Thank you, Mr. Ganesh. Good evening, friends, and I hope all of you are well and participating this evening on the Page Industries earnings call. I will detail the financial performance starting with Q3. The revenues are, as some of you would have read, it is 12,233 million, comparing with year-on-year 11,898 million, a growth of 3% on revenues. And the quarter-on-quarter, it is a degrowth of minus 3%. The EBITDA reported is 1,928 million, compares with year-on-year 2,507 million. This is a degrowth of 23%. And also quarter-on-quarter, there is a degrowth of minus 19%. The EBITDA margins are 15.8%. It compares with 21.1 year-on-year and 19% quarter-on-quarter. However, the 9 months OPEX are in line with the historical trend of 23% of revenues. Q3 at profit after tax is 1,237 million, compares with 1,746 million year-on-year. And this is a degrowth of minus 29%. And quarter-on-quarter, there is a degrowth of minus 24%. The PAT margins delivered are 10.1, compares with 14.7 year-on-year and 12.9 quarter-on-quarter. The gross margins are about 2% less due to the absorption and part of the material cost, as explained. And this compares 37.5 for the quarter, compares to 39.4 year-on-year. The 9-month volumes have shown a 23% growth from 141 million to 172 million. The 9 months revenues have shown 38% growth from 27,754 to 38,195 million. The 9 months EBITDA similarly has grown by 41% from 5,184 to 7,284. The EBITDA margins of 19.1 for this quarter compares favorably with 18.7 year-on-year. 9 months PAT has shown a growth of 42% from 3,459 million to 4,929. The 9 months PAT is healthy at 12.9%, compares with 12.5% year-on-year. The cash and cash equivalent has come down to 408 million. It was 833 million in the previous quarter due to higher inventory. The inventory stands close to 14,900 million. It was about 600 million in the previous quarter. The net working capital is about 8,045 million and compares with 7,886 million in the previous quarter. So I now request the Q&A session to commence.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask question, please press star 1 now. We have a first question from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, sir. Am I audible?
Yes, you are. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. Sir, I just wanted to better understand this ARS hit that you have quantified. Would you be able to give us some sense on the quantum of the hit that we saw this quarter from this shift, and whether the impact is more or less done, or it will take another quarter or a few more months to kind of stabilize? Just if you could kind of share some details on that. Thank you.
Yes, Mr. Mehta. On the ARS front, we reinstated category-wise. We started off with men's innerwear, and the last category where we migrated to ARS was the outerwear category. And as we speak, we have actually cleaned up around 7 million pieces of excess inventory which was there in the system. And this is what has basically affected the primaries. But as I told you before, this is something which is very essential for the long-term growth of the business. And because it is very important, we have a very hygienic and healthy stock in this pipeline. And we wire our systems in such a way that we go by the true demand as far as sales is concerned. Coming back to your question as to whether this is fully done, I will say it is more or less done. But there is little bit more of cleanup required, which is happening during the month of February.
Okay, so it will take probably, fourth quarter also might see some impact. Then that is the understanding.
Yes, to that extent, as far as primaries are concerned. But we are very happy to see that the secondaries are doing well generally.
Mm-hmm.
But if you see the general retail environment, Q4 to date is not very different from Q3. So we are hoping that things will improve from Q1 of next year, and we all geared up. Being a dominant market player, we will be the first to take advantage of this, and we are well prepared for it. In the meantime, as you rightly said, all brands, and if you see generally there is a slackness, and therefore we are taking all measures of tightening our belts.
Got it, sir. So if I may paraphrase, you're saying that there was a slowdown in the environment itself, plus
Yes.
we had this required need that ARS had to be done, both of which is the reason. And out of that ARS might be at a lower level, but the environment will probably take. We are hopeful that it should kind of come back by 1Q. So that is
correct. That is what we are hoping. We hope it can't last more than Q3. So we are closely monitoring that. Sorry, Q4. So I think by Q1 things should normalize. That is what we expect. But we are closely monitoring, and in the meantime we are taking all necessary measures to be very conservative as far as our spends are concerned for next year, and make sure that we have only the need to have spends, concentrate on the core, and maybe watch how the situation turns out next year for making investments for future. However, our long-term view is very optimistic, so we will be continuing to have our share of marketing spends as we usually do, because that is very essential for the brand, and our outlook, long-term outlook, is very, very positive.
Got it, sir. And sir, I have two more questions, but I'll just ask the second one and probably come back to you. Was on the high-cost inventory. This was essentially the impact of this high-cost inventory is done, sir, and hence fourth quarter should move back to the 20-21% EBITDA margin. Is that a fair estimate to kind of assume, or is there any change in that expectation as well?
Yeah. So as I told you before, as far as the impact in margin is concerned, it is not only the high cost inventory or the material cost, it is also the low absorption of the factory overheads. And compared to last year, if you look, our advertisement spend, we are normalized. We can't be media dark forever. So we are reinstating those spends. But to answer your specific question on inventory, yes, we now the inventory which we bought at a lower price should start flowing in from Q4, and we should be able to see the benefits of that flowing into our system.
And the second part, so we don't need price hikes, right? We've not taken any price hikes, or have we in this quarter because of the factory overheads, because of the need for investment? Have we taken any product price hikes that we should be aware of?
No, we have not taken any calls as regards price hike is concerned.
Okay, sir. Okay, I'll come back for the next question afterwards. I'll come back in the queue. Thank you very much, sir. Thank you.
Thank you. We have next question from the line of Varun Singh from ICICI Securities. Please go ahead.
Am I audible?
Yes, you are. Please go ahead.
Okay, yeah. Thank you very much for the opportunity, sir. Just wanted to understand that how much would be our revenue contribution from the EBOs?
Casey, you want to take that?
Sorry, sir?
Okay.
Yeah. Varun, sorry, we don't share those channel product category information in detail on the call.
Okay.
Yeah. Do you have any other question, please?
Yes. And sir, my second question is, sir, if I look at your total distribution, so we see that there is a 13% year-on-year increase, but the revenue growth is only 3%. So just wanted to know that how should we read these two numbers?
Overall, on the store growth, the revenue per store is around 1 lakh, and that has been more or less maintained. Be a little bit plus minus across the quarters. So the store growth and the revenue growth is more or less in sync.
I understand that, sir, but like our current number, there is a big difference, like 13% versus 3%. Even EBOs, there is 19% increase year-on-year, but compared to 3% revenue growth. So just wanted to reconcile that. How should we kind of understand the difference between these two numbers?
There is always an age and gestation for every store to reach full scale or mature. So one should use a lag. What we typically do is same store growth, those kind of metrics. I will request Mr. Ganesh to explain this in more detail.
Sure. So that will be very much helpful. That's it from my side. Thank you very much.
Okay. Mr. Varun, just to clarify, you see that growth you are talking about is only for this quarter, which is more of a one-off. If you see our year-to-date performance, our growth is in line with the retail expansion, whether it's EBO or MBO expansion, it is in line. So this particular quarter, the primary, this is mainly because of the ARS also. The secondaries are in line. It is not a big concern as this is a temporary blip through which we are going through.
Okay, got it, sir. Yeah, understood. Thank you very much.
Thank you, Varun.
Thank you. You have next question from the line of Devanshu Bansal from Emkay Global Financial Services. Please go ahead.
Yes, sir. Thanks for the opportunity. So Q4 has several tailwinds like delayed winter as well as the base is low due to Omicron and GST hike that was there last year. So still the commentary is not so encouraging. So how should we see this? Have we seen a similar to Q3 kind of a decline in Jan as well?
Manshu, if you look at last Q3 and this Q3, the base itself, there was a small challenge because the sales in December of last Q3 was so high because of the expected GST increase, and that led to a higher base. And that also has slightly impacted us when we compare quarter-to-quarter performance. Of course, the main reasons are the ones which I stated before. See, as I told before also, if I look at month to date, Q4 is looking similar to Q3 as far as the buoyancy in the market is concerned. It's not as expected. And we are watching for signs of recovery, closely monitoring. And in the meantime, We are also taking necessary action in the long term to preserve cash, tighten our belts, and to focus only on the core so that we can improve and maintain our margins in the long run.
Sir, still I just want to understand this in more clarity. You said in Q3 secondary sales were good, but primary lagged due to ARS implementation, and now in Q4 there is similar sort of a demand environment, but that primary billing should have helped us for jockey sales growth, right? Why is that getting impacted in Q4?
No, see, the Q4, we are only midway through Q4, so we need to closely monitor. What I'm saying is generally in the market, we are not seeing any recovery in the market. So it is not as buoyant as we expected. And that trend which was there in Q3, we are seeing it in Q4. That is what I meant. As far as primary sales are concerned, it all depends on how the secondaries take off from now, and that is what we are basically watching.
Got it. And this demand slowdown is across categories, or it is specific to some of the categories which we operate in?
Though I can say it is across categories, the heartening thing is some of our core categories like men's innerwear has shown a double-digit growth. Growth, of course, is softer than past, but it has recorded a global growth, a double-digit growth, and that's our core of the business. So that is very heartening. Categories like bras are well accepted. It has shown a very good growth. So it is not across categories. We have categories which has grown pretty well.
Got it, sir. And last question from my side, sir. Other players in the market are operating at very thin margins, and some are making losses as well in this category. So how are we trying to protect our shelf space from such competition in the general trade?
Well, I think the main thing would be, the AR will make sure that the inventory terms are pretty high as far as the distributor is concerned, and the distributor's inventory health when it improves, it will definitely help him to serve the retailers. So, I feel, ARS is a very, very critical initiative which we have taken. And the second is, we are the dominant player in the market. So, as far as retail is concerned, this is going to be a fast-moving product for them compared to others, and that should really help. I think, again, if you want, you can add more clarity to this.
Thanks, Mr. Ganesh. Yes, I more or less have answered. So one key thing, as Mr. Ganesh has said, that by implementing ARS, we are able to give the consumer exactly what he wants, rather than the distributor placing the order as per his intelligence. So that is something we are far closer to the consumer in terms of placing right at the retail point what he wants. Second, our distribution. If you look at our entire network, while you are saying that there are players with lesser margins, but they do not have the kind of the distribution footprint that we have, and which is serviced directly by our employees and by the distributor employees, right? So, and being the dominant player, the retailer obviously, keeps the share of jockey what is required as per the market. So it cannot go to somebody else just like that. So because of that, we are very confident. And lastly, consumers do recognize our entire product quality, so it is not just on the margins which other players are playing on, but they truly believe in the quality of the product, both the retailer and the consumer. So as long as we are present near the consumer and we are delivering to the consumer what he wants, and we are a value product, though being premium, affordable premium, I don't think there is any cause of worry there.
Got it, Gagan. Just a small follow-up. Is the competitive intensity higher post-COVID? Just a small comment here would be helpful.
Yes, it has become more intense because during COVID, a lot of players were not able to really supply, So at that point of time, so now everybody has come back, everybody has ample supplies. And also, if you look at the athleisure category and all, there are more and more players who are, entering into this space. So the competition has become intense, but then we are very, very confident of our product, and and we will continue to grow. So we are very optimistic of the future, despite the competition, and the competition keeps us on our feet, which is important.
Thank you, sir. That's it from me.
Thank you. We have next question from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity, sir. Sir, sorry to repeat this question, but my question again is more in terms of the demand. While we are recognizing that there was an ARS mismatch leading to a primary-secondary disconnect, but if you can qualitatively comment more on the demand front, as in what is leading to this demand slowdown? Is it that there was a high base of some COVID products, which is now getting normalized, leading to this YY declines? Any color of this would be helpful.
Gaurav, what we see is generally the spends have come down, and the basket size has also reduced. If somebody used to buy 4 pieces or 3 pieces, it has come down to 2 pieces. Maybe I think this is because of the general economic environment, and it is a bit sluggish, and people are conservative. I think very, very tight on the spends. I think the share of the wallet is a temporary thing. With back to office, back to work. There is also a huge spend when it comes to the outerwear. It's a formal wear which people are buying now because they have to refresh their wardrobes. And when you have a limited wallet, your athleisure will be something which will be postponed as far as buy is concerned. So we do see that trend also as far as the outerwear is concerned. Even though over the year for 9 months it has shown growth. During this quarter we are seeing that trend, which we feel is temporary.
Sure, sir. Sir, and my other question is again with regards to this the high cost inventory that is now getting over. So in terms of pricing, if I remember it right, you had taken an 8% price increase around in the December last year, and I believe that is going to overlap now in Q4. So what kind of pricing are we looking ahead from Q4 onwards on a YY basis, and especially in the context where the raw material prices have come down sharply?
Yes, sir. But when we looked at the pricing intervention last time, if you see, we didn't touch the prices like everybody else because we took a long-term view, because we wanted to continue to be a value for money brand for our consumers, and we took a projection of how that raw material trend will work, and then we touched the price accordingly. Things more or less have happened as we expected, so this is something which we have considered. So as we speak, we are not looking at any immediate price interventions.
Sir, but if I get it right, I mean, you generally take a 3 to 5% price increases every year. So will the same trend will be maintained in the coming year as well?
You are asking whether we will be increasing the price by 2 or 3% next year? Am I right?
Yeah. Yes, that's the regular ones that you do usually.
We need to watch. It all depends on the raw material price movements. As you rightly said, it has softened over last year. So if the trend continues, we can be more conservative on that. But this is only time can answer. We are just watching how the input costs are going to move. So we will take appropriate call at the right time based on the input cost movement.
Sure. So just lastly, 2 more questions from my end. One is on the distribution front. Given that you have been aggressively expanded distribution over the last 1.5 to 2 years, so in the wake of this recent slowdown in demand, would you also consider some slowing down in the distribution expansion as well?
We are looking at a normal expansion because we are not present everywhere. There is so much headroom. So, and as I told you, our long-term view is very, very positive. So we are actually not slowing down on those aspects because there is so much potential out there, and we are continuing to be aggressive as far as retail expansion is concerned, both in EBO and MBO space. Gagan, would you like to add anything more? Hello?
Sir, in case, sorry, sir. In case Mr. Gagan is not there,
Sorry. So yes, I think Mr. VSG, sorry, it was on mute. You've answered it, and as Mr. VSG said, that we are also building for the future. We are very, very optimistic, and wherever we see that there is a gap and an opportunity where we can be present and be nearer to the consumer, we will not hold ourselves back. This is temporary, 1 or 2 quarters, but we need to be near to the consumer, so the distribution footprint expansion will continue. Yes, we will not go on a rampant drive, keeping that, we have to open X number of outlets and, there is a certain target that we have in mind. But we will go slow and steady in terms of wherever there is an opportunity, we'll make sure that we'll move there faster than ever. So it will continue. And this year also, you've seen there's been a 10% increase in terms of our distribution footprint. So there's no reason this will not continue in the future.
Sure. Thank you, Mr. Gagan. And just one last bit, sir, if you can clarify the volume in pieces for this particular quarter, or maybe the 9 months that you called out for 9 months FY23, I just missed that.
You want to have the volume for the quarter?
Yeah, the fourth quarter and 9 months exact volume in pieces, if you can highlight.
The volume for the quarter is 52.8. I hope you can hear me.
Yes, I can hear you.
And the volume for the 9 months is 172.4.
Thank you, sir. Thank you. That's all for me.
Yeah.
Thank you. We have a next question from the line of Rishi Modi from Marcellus Investment Managers. Please go ahead.
Hello, am I audible? Hello.
Yes, we can hear you. Please go ahead.
Yeah. So my question is on the attrition part, right? Your channel sales team seems to have decreased from 759 to 714 in this quarter. This is a QOQ number. So just wanted to understand what's happened here. Have there been layoffs? Has it been a natural attrition where people are going to our competitors?
Gagan, you want to take that?
Yeah, it's a natural attrition that's happened during the course. So it's nothing to do with the tertiary sales as such. So it is something that's temporary, and obviously, we will, as and when we'll get the replacement. But as Mr. Ganesh had mentioned earlier, also that we are being, very, very prudent when it comes to our expenses. So wherever there is a requirement, we'll obviously plug in the gap. So it's a natural attrition. There is nothing by design or, and people do move during this time. So somebody would have changed industry, somebody would have gone to competition. So it is something that's happened, earlier as well. So there's no cause of worry there.
And
sorry, I can add to what you said. We also taken a lot of initiatives on productivity improvement, and with that initiatives in place, we need not have a one-to-one attrition replacement, because we are seeing signs of improvement on the actions which we are taking. The productivity of the sales team is improving, and there is much more work which is happening on that front. So we can afford to be more prudent as far as investment in people is concerned without affecting the business growth.
Got it. So basically, your ARS should help you free up some resources.
Absolutely.
Right. All right. So staying on the sales line, right? I see that our MBO or our LFS touch points have been volatile in the past 4 quarters, wherein in Q2 we dropped down from 3,000 odd touch points to 2,700 odd touch points, and now we've got back some 225 odd touch points. So could you explain the trajectory? What's happening here? Are we not getting acceptability in certain type of LFS stores, or what's happened? Why is there such sort of a volatility in the LFS sector?
Thank you. Thank you for asking that. We have Rahul Shukla who with us today, and he'd be the right person to give you clarity on this.
Thank you, Mr. Ganesh, and thanks for this question, Rishi. There's no volatility as such. As an ongoing process, we do keep looking at critically evaluating our relationships, and wherever there is a synergy with page values and the aspirations, we continue with our expansion with these point of sale. They need to be profitable, viable, and meaningful for both the partner as well for us. We are the preferred partner for expansion for practically every player in the LFS ecosystem. And coming out of the COVID, there was some rationalization that the LFS partners themselves had done with some of their stores, which were probably not viable or not working, because in the LFS ecosystem, we operate on the expansion that the partners do, not that we do. So we remain very buoyant and very upbeat on the prospects of our growth in the LFS ecosystem. We are the preferred partners. We occupy a leadership position in the segment that we operate in the LFS. So there is no such concern of any volatility on that front.
Okay, so like what explains that drop in 280 LFS points in Q2?
So there are whole different types of large format stores. Without getting into the names of those partners, there are some regional players who might not be a viable proposition. They might be rationalizing their own stores. So wherever we don't see synergy with the partners, we rationalize and we look at only those partners where there's a mutual synergy between the two.
Okay, so if I am to read into this, I'm guessing the value format is where we would be struggling because the customer base is not really at.
Not necessarily. If you look at not necessarily, because of the value for money proposition that Jockey offers. Even in the value format, we are doing quite well. I'm talking about more some regional players that probably themselves might be finding it difficult to sustain their chains, and hence would be rationalizing their own chain of stores, not the national chains as such. With all the national chains, we have a very robust relationship.
Understood. My next question is, you mentioned that there's been some factory overheads, and hence we were underutilized on the factory front. Could you give more color, more details on that? What happened?
Yeah, I can take that. For example, we produced about last year this time about 38 million, and this time we produced about 42 million pieces. So the production was less because the sales was less, as explained by Mr. Ganesh. So invariably we have an absorption at the standard rate into the COGS, and we had last year a good absorption, which means that there was about a 3% better absorption of the labor and factory overhead. This time we didn't have it. It was almost flat. So in comparison, there is about a 2.8% lower absorption of the labor and factory overhead. If you don't produce enough,
right,
what you actually pay out to labor and factory overhead, a part of that remains in your P&L.
Understood. Okay. So now that our ARS system is in place, right? And I think last quarter also you said that we are in line, our primary sales and secondary sales were largely flowing in line. So going forward, we should be seeing inventory reduction at our end as well as the retailers or the distributors' end. So this quarter, what are the inventory days versus, let's say, last quarter and Q3 FY22? Like how much of inventory days savings have we done because of our ARS?
You're talking about page inventory, right? Not the channel inventory?
Yeah, our inventory, company's inventory.
Yeah. Overall, including raw materials, we are at the highest point, as I mentioned, and from here we will only see the inventory come down quarter on quarter and then at an optimum balance level. So right now we are carrying close to about 3.5 months of inventory. Yeah.
And what was it, let's say, last year, same quarter?
Last year, same quarter was about half of that because we didn't have inventory, and that is why this build-up happened over this, in the past 3-4 quarters. So last year we had almost half number of days, I'd say.
Yeah, because let me just give you the perspective here. Last year we were struggling as far as inventory is concerned because of the supply chain disruption and the huge demand which we had. Our number of days inventory was very low. In fact, we had some lost opportunities because we were not able to fulfill all the demand which was flowing in. Right. So it is not comparable. So now we have additional inventory because we built some strategic raw material stock because it was very volatile out there. Even if we are willing to pay price, the supplies were not coming through. That those were times when the demand were also high, and we actually invested in stock, which we believe is the right thing to do. And that is what is now getting utilized. So you will see as we move forward, the inventory is reducing and normalizing.
So what would be our, long-term target for inventory days? Like, where can we be on a sustainable basis?
About 2.5 months on an average. Inventory on revenues, to add to what Mr. Ganesh said and clarified. So, for example, if you go back to last year, Q1, we had about 110 days of inventory, and then it came down to below 60 because Q2 and Q3 last year were better than expected, and we almost were very, very low on inventory. That's why we came to that. So 2.5 months is about the right number of days that we would plan, and more importantly, to have the relevant inventory to maximize the sale. So those kind of efforts, yeah.
Understood. Okay. Final question.
Mr. Modi, could you please come back in the question queue?
Sure.
Thank you. We take next question from the line of Samir Gupta from India Infoline. Please go ahead.
Hi, good afternoon, sir, and thanks for taking my question. I have 2 questions. So first question on the gross margin, and this is the COGS line that you report in the reported SEBI format. I see that there is a contraction of 340 bips on a sequential basis. Now, there is a high price inventory which we had and which was getting normalized this quarter, and there is more to go. I don't understand why sequentially our gross margin should reduce unless there is a very adverse revenue mix that we have seen this quarter. But you also clarified during the call that the men's innerwear, which I assume is the higher margin product, that has seen a double-digit growth. So I'm not able to understand why GM contraction should happen on a sequential basis. Thanks, sir. That will be my first question.
Again, good question. Thanks. Let me take that. I explained, I think you may have missed earlier in the call, couple of questions before, that we had about 2.9% lower absorption this quarter. So that is why we are seeing this. So when the production and the resourcing, which is the labor and the factory overhead together, are balanced, then typically we should have the production should absorb all the cost being incurred. That is the reason, main reason, I would say. Am I audible?
Yes, you are.
Okay.
Thank you. We take next question from the line of Akhil Parekh from Centrum Broking. Please go ahead.
Hi, thanks for the opportunity. Sir, if I look our performance versus, say, apparel retailer or a footwear retailer who is operating into a mid-premium, premium segment, they have continued to deliver very strong, even in the third quarter, and there is no sense of weaker retail demand. So my question is, our lower performance, has it to do with the increased competitive intensity in certain pockets and not much to do with the overall weaker retail environment? That's my first question. Hello. Hello.
Members of the management, we are unable to hear you.
Oh, I'm sorry, Mr. Parekh. What I was clarifying was like when we look at the competition, we can see that we have done much better than all the competition. And I was just trying to clarify that it's very, very important that we look at it at a category level rather than at an apparel industry level. If you look at it that way, you will find us performing much better than the competition.
Okay. Okay. So there is no meaningful change into competitive landscape as such. Basically. That is what you are trying to imply.
Yes. Yes.
Okay. Okay. And my second and last question is, could you give some color in terms of demand slowdown across tier 1, tier 2, and tier 3 towns? Is it same across all three, or is it different across the different tiers?
Mr. Parekh, your line was not clear. I couldn't make out the question.
No, my question is whether the demand weakness is democratized across different tiers of towns, or is it more specific to, say, tier 2 and tier 3, and probably tier 1 is doing relatively okay as compared to the tier 2, tier 3 towns?
It is what we see is generally across the board. We couldn't see any particular rural or urban. But one thing we are seeing, the premium, the consumers who are buying a premium product, that we don't see any slackness there. But it's overall, if you look at it, there is no much difference between the tiers of town.
Okay, sure, fair enough. That's all from my side. Thank you so much.
Thank you. We take next question from the line of Samir Gupta from India Infoline. Please go ahead, sir.
Hi, sir. I'm sorry I got disconnected. Just on that follow-up on the GM question. So when I'm looking at the 340 bips contraction, I'm basically looking at the raw material consumed line and the change in inventory line that you report in the SEBI format. So there the overhead absorption should not make a difference, right? This is purely the sales that you do and the raw materials that you consume.
Correct. This is what Mr. Ganesh also explained at the beginning of the call, that there is a higher price raw material which is coming in, and we had gone pretty low on inventory in Q3 of last year because the demand was better than expected, and therefore there was an inventory build-up at higher price during Q4, Q1, and so those inventories are now reflecting into the Q3 at the contribution level.
Again, sir, just a follow-up. So I am looking at from 2Q to 3Q. So if at all the consumption of high inventory is happening, probably it should reduce in 3Q versus 2Q, right?
Again, it is, the weighted average of the inventory has started reflecting more in Q3 than in Q2.
Got it, sir. Second question, sir. So now we are seeing a general slowdown in discretionary consumption. This is across companies. This is not only with Page. So in this context, what do you envisage? I mean, when can we get back to a double-digit growth trajectory? And I mean, I would still assume that the macro or the consumption environment would need to pick up, even with the primaries and the secondaries difference that you are having. Getting back to a double-digit growth trajectory would still require overall consumption pickup, and what could be the drivers for that?
Samir, few things which we need to, one is to have a close look at the market and see, because we need to bounce back the moment we get the opportunity. From our side, we expect things should normalize by Q1. But what we are looking at as an organization is, even if we have only a modest growth, and if this continues even in Q1, Q2, how can we maintain our margin? So we are looking inward and see what all cost controls we can put in place, and what all are the governance measures that we should incorporate in our system so that we can protect our margins. And if the market recovers faster, then it's a bonus. So that is the outlook we have. So we are looking at the very essential expenses, focusing on the core of the business, and postponing other investments which can be postponed, so that we can maintain the margin, watch how the market recovers, and invest for growth when the market normalizes.
That's very clear, sir. That's all from me. Thanks and all the best.
Thank you, Sameer.
Thank you. We have next question from the line of Resham Jain from DSP Investment Managers. Please go ahead.
Yeah, hi. Good evening. So just to clarify, you mentioned about 5.28 crore of inventory. Does this mean that this quarter you had 11% kind of volume degrowth? Is that the right number I'm looking at? Hello.
Casey, you want to take that?
You mentioned about 11% year on year. Is that the question? Resham?
Yeah. My question was 11% volume degrowth. Is that the right number?
It is.
Okay. Secondly, my question is on EBOs. The ARS system which you have implemented in this quarter, or you have reintroduced from last few months, is it applicable for EBOs also, or this is more to do with MBOs?
Mr. Jain, this is more to do with the MBOs. EBOs, we are always following this work, so this is more to do with MBOs.
So can you, just to get a sense on how the secondary movement might have been, can you help us with the EBO growth number in this quarter?
Mr. Jain, as Mr. Chandrasekhar clarified last time, we don't give channel-wise breakup. It is good for all of us to not share those information which is competition sensitive.
Okay. So why I'm asking this specifically is because let's say if EBO secondary sales and ARS is implemented, then the MBO might have actually degrown much higher than, from volume perspective, higher than what we actually see for a company as a whole. Because in the past, you did mention about EBO being 20% of your sales. Is that statement correct?
Yeah, the impact, as you rightly said, is you are right in your judgment as regards impact is concerned, because if you look at the primaries, the secondaries is what we need to look at when we are doing this correction. So secondaries has been now getting in line with primaries. That shows that inventory correction has more or less happened. But you are right, the impact has been more on the MPO side because of the correction which we undertook through the ARS system.
Okay. So the last one is on in-house versus outsourcing mix, because what we could see from numbers, and I could be wrong here, that your purchase of traded goods number as a percentage of sales has been going up consistently since last few years. So has your own manufacturing contribution has come down? If you can just give a sense of how it has moved over the last 3 years, that would just help to understand the trajectory. That's it.
Mr. Jain, we always have been around 33 to 35% of what we sell has been outsourced. So we have always maintained that. We have not increased it. There was a slight increase during the pandemic time because the demand was very high, and the quickest way to augment capacities were through outsourcing. But we are back to the same 66, 33, 34 ratio. Long term, we will continue to expand because you should also understand it's a growing concern. So while we internally grow, outsourcing also grows because the overall demand, if you see the year-to-date growth also, it is significantly high growth which we have had. And as the relationship with our supply partners improves, and they are like extended arm of Page, we may look at a higher ratio also, because they are just like another factory of ours. They are like franchisee factories, and that's the kind of relationship with which we have built this. So we will continue to look at that so that we have a good balance between in-house and outsourcing. This is very important to have agility with more and more volatility in the business. If there's a quick upside which we need to look at, we need to have both the levers in our hands.
Okay. Very well explained, sir. Thank you. Can I squeeze one last one?
Please go ahead, sir.
Sir, just one is on kids. Just based on what we understand from the market, kids which we were expanding quite rapidly since last 2-3 years, or 2 years specifically. We have seen some slackness there at the marketplace and some slowness. If you can just explain what's happening on the kid side. Has there been any change in strategy? Or are you seeing anything in the marketplace specifically? Thank you. That's it. That's all.
Yeah. Mr. Jain, we are seeing good growth in kids. I'm not talking about Q3, but if you see year on year, we have grown significantly. So there is no slackness as we see. Of course, we are taking measures to see how we can further accelerate the growth of this category. But it has grown to our plan.
Okay, sir. Thank you. All the best.
Thank you. We have next question from the line of Ashish Kanodia from Citi. Please go ahead.
Yeah. So, sir, the first question is on the gross margin. So if I look at the 4Q22 gross margin, my understanding is it benefited because of the price hike you took in anticipation of the GST rate hike, which never happened. So is that understanding correct that, the 4Q22 gross margin was actually higher?
Not exactly. The price corrections which we took because of the input cost pressures, because of the cotton price. There also we didn't want to cover the entire expenses because of the input cost pressure. We were looking at taking a long-term view, and we were looking at how the projected cotton price is going to move and touched accordingly. So this price increase was not purely because of the GST.
Sure, sir. Secondly, if you can highlight, what is the costing approach on raw material? Is it like or for the COGS, is it first in, first out, or is it a weighted average?
The method is weighted average.
Sure, sir. And the last question is, you talked about the lower absorption of overheads in 3Q. Now, if I just weave through some of the earlier commentary, so we are already at highest point of inventory, and then there is some slowdown as well in demand. So is it fair to say that, when we look at 4Q, maybe, again, that because we are all carrying some inventory, so the production level would be lower than maybe sales, purely because demands are, expected to be slightly muted, and you have already high inventory, and we may see some, lower absorption in 4Q as well?
Mr. Jain, what we are doing is, we have raw material, and see, as I told you before, so long-term outlook is very low. What we are doing is to utilize the capacity and produce what is safe. So we are looking at the core products, the 80-20 rule, the 20% of the volume which gives 80% of the revenue. Those products we are producing so that we can utilize the capacity which we have installed, and we are also worked with our vendor partners who from the outsourcing side, and most of them work for multiple buyers, they are able to manage their capacities, and we are in a position to slow down the offtake from there. So this is where, as I told you before, it is very important as a company we have both the levers in our hands so that we can manage this well.
Sure, sir. This is very helpful. Thank you.
Thank you. We take next question from the line of Vikas Jain from Equirus Securities. Please go ahead.
Thank you, sir. Thank you for the opportunity. So my first question is with respect to your outlook in the growth that we estimate for FY24. Can you elaborate as to which segments will deliver the growth for us in FY24 as a whole, and also color as to how is so will it be like a women's wear or kids wear that will be the key front runners, or will it be equally contributed by the menswear as well as athleisure also? Some color there, please.
Because it definitely has to be across the board, because if you look at the market share which we have and the headroom we have, there is tremendous potential to grow in all our categories. So, and that has been the case. If you look at year to date, all our categories have grown, and that will be the trend going forward as well.
Correct. So, but would want more so from the perspective of men's and athleisure wear as well, right? Because last year in FY23 we have seen a very a good growth in the athleisure as well as the menswear category, whereas we are making incremental efforts to grow in our women's wear and as well as the kids wear. So, more so from the perspective of will it be like a base effect that will be coming here, and hence the growth will be much higher in the new emerging categories, or it will be like even in terms of percentage wise also men's and athleisure will be doing at a similar pace that we witnessed in FY23 till date.
I feel the emerging categories like outerwear, especially women's bras, they should have an accelerated growth because we have less penetration and there is much more headroom. But overall, all categories should grow. Athleisure, yes, during the pandemic, as the consumption pattern was such that there was a higher demand for it and it softened post-pandemic. But long term, that should definitely grow, because pandemic was a great opportunity for many of our consumers to discover our product on athleisure, and it was something wherein we were able to enlist a lot of new customers. So this is definitely going to help us in the long run.
Correct. And so, and some color with respect to the current quarter, that is CQ of 23. Any color as to which category did well and which category was under pressure?
As I told you, men's innerwear category did comparatively well. It recorded a double-digit growth. Our bras category is well received. It has also shown a good growth. Softer than usual, but it has grown.
Sure. And athleisure?
Athleisure, if you look at year to date, it has definitely shown a decent growth in line with our expectations. Yes, quarter 3 was challenging.
Sure. So, in my last question, in last call we did mention that we are now focusing on the exports market as well. So, any meaningful progress that we have achieved this quarter?
Sorry, Mr. Vikas, was not able to make out the question.
I was talking about that in last earnings call we did mention our increased focus on growing in the Middle East and other export markets. So any meaningful progress that you have achieved there?
Yeah, so in the last call what I was saying is we are concentrating more here, and as far as overseas market is concerned, we are concentrating more on the Middle East, because with the economic situation in Sri Lanka and Nepal, it's not so buoyant. Therefore, whatever effort we are putting in, it's more focused on the Middle East market for the time being, and we are closely watching how these markets are recovering in the other territories.
Right. Okay, sir. Thank you so much.
Thank you.
Thank you. We have next question from the line of Rahul Jain from Phillip Capital. Please go ahead.
Hi, this is Ankit here. Just wanted to understand, sir, our new capacity from Odisha is expected to come in the month of April or May. From the rural distribution side, we have done a lot of good work, and broadly this is going to be for modern classic. How are we looking at rural distribution to take care of this capacity? And would we initially start with double shift or single shift only, given the current demand environment we are in for this capacity?
So Odisha, when we commence operations, it will be in single shift. We always will have the option to go to double shift. But the commencement of operation would be on single shift because there is a huge effort required as far as training the operators and getting the efficiencies. It is much more easier to manage it if it's in the general shift. And as we move forward, if there's a need, we can always explore the double shift opportunity.
And so can you elaborate on the rural distributorship? What has been the progress and how do we plan to utilize this incremental capacity? Because, few questions back you answered, you want to be, 65-35 in outsourced and own manufacturing. With own manufacturing share increasing significantly with this capacity coming in, where do you plan to use this product? Which product are you looking to manufacture and from a distribution perspective?
Okay, so Odisha is going to manufacture the men's innerwear product. And as far as capacities are concerned, Odisha capacities is more of a replacement of some of the capacities which are here in Bangalore as a modernization project because some of our units here are getting rationalized for other operations and we are moving some of our sewing capacity to Odisha.
Sure. So can you also talk on the rural distributorship?
Yes. Gagan, you want to take that?
Yes, Mr. VSC. So, we currently have around 150 distributors who are purely in rural, whom we call the DHQ distributors. So we have made some rapid expansion. This used to be almost half the number, a couple of years back. So currently we are present and we are servicing till the last taluka. So, and also if you look at, because of these exclusive distributors for rural, in the last 2 years, we have opened almost 50,000 new outlets, out of which 50% almost have come in Tier 3 and Tier 4 and in rural. So our focus on rural continues in terms of both our retail expansion as well as exclusive distributor who will focus on limited styles for these rural markets. And the journey will continue. We are very optimistic of continuing here and we have the markets already planned out where we'll be opening more distributors as well for exclusive rural distribution.
So did I hear right? You have 150 distributors for the rural market today?
Yes.
Understood.
These are distributors who are only focusing on rural markets. There might be some other distributors who might be in the city and if there is a rural market nearby, they might be servicing. These 150 are exclusive only for rural.
And typically these would be catering to 150 towns in their small geography wherever they are.
Yes.
Understood. That's helpful. Thank you so much.
Thanks.
Thank you. We take next question from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, sir. Sir, I just wanted to check on the inventory bit. Now, what drove the sequential increase in inventory? Was it more to do with demand being lower than what we were expecting, or was it more linked to ARS?
Mr. Mehta, I will say it's both. And there is also a movement of inventory from raw material to finished goods because we are utilizing the raw material which we have pre-positioned as a strategic stock. But, the demand has been lower than what we planned. So that definitely is one of the reasons.
Okay. So essentially we produce, sir, but finished goods was already high in 2Q. So is it finished goods inventory rose further? And that was not looking like that. That is the way to understand.
Yeah. So the way we have wired ourselves, you will see getting reduced and normalizing the coming quarters.
Mm-hmm.
And we start seeing improvements from Q4.
Okay. And sir, to ensure that this similar thing doesn't happen because, we expected something similar to happen in 3Q. It's just that you will watch how the demand pans out and that's how the production plan would possibly be a little delayed. That's how you would that is what would be the reason that gives you more confidence in moderation this time, right, sir?
Yes, because we can always manage the capacities with outsourcing vendor partners also.
Okay.
And that's where we have done significant corrections as far as outsourced quantities are concerned. And this is why I said, you would see us improving on this front. From Q4 onwards, you will see improvement.
Perfect, sir. And second bit, sir, just following up on the margin bit, the way we see inventory being, this is the process, the peak of the inventory, would it also be fair that this is probably the bottom of the gross margin and EBITDA margin because things will only improve? It's nothing incremental cost that is coming in, it's the high cost inventory that is going away. Would that understanding be correct, sir?
More or less, because, we have been utilizing the high cost inventory, but, the main thing we need to see is also how the market recovers because it's important we get our top line. And that's where we are working very, very hard on.
Okay. So the margin performance will be dependent on how the growth pans out is what you would kind of argue. Fair enough, sir. Okay, sir. That's all from my side. Thank you very much, sir. Thank you very much.
Thank you. We have next question from the line of Prerna Jhunjhunwala from Elara Capital. Please go ahead.
Thank you for the opportunity. I had a question on penetration levels. With the increase in our distribution network over the last few years, would you just like to understand the penetration levels across categories that you used to talk about pre-pandemic?
Gagan, you want to take that?
Yes, Mr. Ganesh. So, as we have been mentioning that, while we have grown, but we also see a lot of headroom because when it comes to penetration, even when it comes to the men innerwear piece, we currently look at a 20 to 22% penetration. But when we look at athleisure, and when we look at juniors, and when we look at women innerwear business, there's a huge headroom because the penetration, what we would have reached by now is around 7 to 8%. So that is the reason why we have expanded our presence in tier 3, tier 4 markets and also in metros as well. So because there is a lot of headroom, because when it comes to penetration, I think there is a lot more to do and there's a huge market staring at us. Hence, we are very optimistic for our growth in the future as well.
Okay. And so my next question is on the women's wear segment. How is the response in the tier 2, tier 3 and rural area for the products that we are present and expanding in these areas? Because we know tier 1 is anyways aware of Jockey as a brand and in the women wear. But how is this response in the newer areas that we are penetrating?
Yeah, great question. In fact, it is equally good, and I should thank the initiatives we took as far as marketing campaigns are concerned, which has created a great awareness across tier 1, 2, 3, and 4 cities. And when it comes to bras or women's innerwear, see, what we need to understand is our TG is the same. They just happen to be there in the rural, but, they have the appetite to buy our product, and they just geographically happen to be there. And therefore, it is very important that we are present closer to our consumers, and that's why we are having a very healthy expansion as far as retail footprint is concerned. Coming to consumption, it has been increasing across the tiers. Of course, there is higher affinity towards tier 1 and metros, but the growth, even in the tier 2, 3, 4 cities, are as per our expectations.
And do you find any resilience in terms of price points versus whatever is available in those markets?
Actually, no, because if you see, even during these tough times, our bra categories, which is a high ASP premium product comparatively, has done very well. It is well received. So it's a clear indication that the consumer respects the value for money proposition which we are offering.
Okay. And so I understand we've been talking on this call about inventory and movement of raw material to finished goods and stuff. So just wanted to understand whether we can see sequential improvement in margins, or it should be near to these levels only, at least for a few quarters, because we are not able to understand when this high cost raw material and finished goods that you are holding should actually exhaust.
I think you'll start seeing that this is improving across the next quarters because we are almost consumed the high cost inventory. But if you look at overall margins, it all depends on how the overall market is. What is giving immense satisfaction for us is, despite all the challenges which we are seeing in the marketplace, we continue to dominate, and compared to the competition, we have performed exceedingly well. And we will continue to focus on that, and we'll be obsessed with what our consumer needs. And that, in the long run, should pay the dividends.
So my last question is on ad spends and promotion spends. Any increase over there in this quarter? And strategically, are we looking at some increase till the time demand improves?
Well, this quarter, yes, there has been an increase because, the marketing spend, the campaigns, they have their timeliness, they need to plan it, and therefore the outlay was comparatively higher in Q3. As far as overall marketing spends are concerned, we are now normalizing it to pre-COVID levels. So we used to spend around 4% of our top line for marketing. We are planning to be in that zone, and there is no need for us to be media dark any longer.
Okay. Thank you so much, sir, and all the best.
Thank you.
Thank you. Ladies and gentlemen, we have reached the end of the question and answer session. And I'd like to turn the call back over to Mr. Chandrasekhar K, CFO, Page Industries Limited, for closing comments. Over to you, sir.
Thank you. Thank you so much to all of you for dialing in and so many engaging questions and very educative and supporting the journey of Page. You all have a good day.
Thank you very much, sir. Ladies and gentlemen, on behalf of Page Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.